In this video we will go through a very famous calendar anomaly, the turn of the month effect. But first of all, this video is no financial advice. Trading is at your own risk. Market can behave differently than you expect. And this video is just for entertainment and education purposes. But go back to the calendar anomaly. What are calendar anomalies? Calendar anomalies are recurring predictable patterns in assets returns based on some calendar dates. The returns are systematically higher or lower on specific days, weeks or months. This challenge of course the theory that markets are rational and efficient. But it is suggests that investors might be able to beat the market with timing strategies. It's very common in both academic research and practitioner interest, and they often disappear after they are published. So it's a kind of self-defeating behavior. But what does the turn of the month effect say? The turn of the month effect says that stock returns are statistically higher during the last trading days of a month and during the first trading days of the month. The turn refers here to the transition to the previous month to the next month, and it's typically defined as that the last 2 or 3 trading days plus the first 2-3 trading days of the next month. It was first researched by Laconce, Schock and Smith in 1988. But why can it be that there are some kind of calendar anomalies or anomalies of the turn of the month? First of all, that pension funds and mutual funds rebalance their asset at month's ends or month's beginning. Then also portfolio managers settle trades and align allocation at this period. It creates buying pressure around the month's boundaries. But it's also in the retail market that people get the salary at the end of the month and invest it at the beginning of the month. That's the theory behind. And then also it's regarding financial statements that corporate and accounting teams finalize the month's end statements. And there are potential timings with dividend and coupon payments. I prepared a code, what I want to show you now. Let's go through the code. First of all, we're loading the most important libraries. We take Yahoo Finance for our stock prices, then pandas to handle our data frame, and we use matplotlib to make some charts of our data, and also NumPy if it's really needed in the code to make some calculations. First of all, we load the S&P 500 index from 1960 till current. Why that long period? Because most of the studies are based on this period, and you will see later that the turn of the month effect worked very well before. So then we need to transform our data frame because we get nowadays a multi-index data frame from Yahoo Finance, and we just need the ticker data and our prices. And more information about multi-index of data frames in Yahoo Finance you can find on my article below. So let's execute the part and we get our time series. Then in our next step we need to do our feature engineering. We will extract the calendar variables. So first of all we need month and year that we need later for our grouping. So we group the data based on month and year and count the number of days and do a cumulate account. That means the first day of a month would be 0, then the second day of the month would be 1, and so on till the last day of the month, which is 20, 21 or whatever. I named it as day of the month up, so we count up, and then we have another counter. I named it day of the month down. We are counting backwards, where we get the last day of the month, which would be counted as -1, and the second last day of the month -2, and so on. And then I need to order it properly. So I define day of the month. First I set it to 100, and then I took the last 10 day of the month and the first 10 day of the month. Let's see why. Because as you can see here, we can see from 1960 it has 20 trading days, and the first trade date of the month is 0, 1, 2, 3, and so on, and you count here backwards. This is the 20 last trading day. For example, from November 2025 we have 18 trading days, and the last trading day is -1, and so on. So we filter this out and skip the middle of the month, because some months have more than 20 trading days. For this analysis we should skip this, and then we calculate a simple linear return, not a logarithmic return in this case, and we calculate also the buy and hold performance. So that means the performance of the whole time series. And we have here our time series with our features, and then we calculate the statistics, the returns by calendar day, and yeah, we see here 0 is the first trading day. We have 791 observations, and yeah, here the last trading day we have less, and yeah, we have middle of the month a lot of observation, but what we will skip them later. And you can see it also here on the chart, and yeah, you can see that there's some kind of positive performance during turn of the month. So 0 here is again the first day of the month, and the first 3 days looks good, they are higher than the other days, and also the last 3 trading days are good. I mean, there's 4 trading days, but based on the study from Lanoch, Schnick and Smith from 1988, they took the last 3 trading days. So we then make also here box plot chart. Yeah, it's not very informative, so we will need to do a statistical test. So for that we need to calculate our trading strategy. So we need an entry signal which signals that we take a long position, and then we also need an exit signal to close this long position and calculate our performance metrics. Here are some assumptions. So we don't take into account transaction cost or slippage, because transaction costs varying very differently based on your broker or based on your position size, and also slippage, the liquidity of market is strongly dependent of the stock you're trading. You also have a perfect signal execution at close prices, which is also not really the case, so because you have to sell shortly before the close of the market, so you won't get exactly the close price. And we also assume that we assign 100% of our capital to this strategy. So you can see here that we need a signal, we need a position, long or short, and we need to calculate the performance of the strategy. Yeah, we start with the last trading days. If we reach the last third trading day, then, and the previous position is 0, so we don't have any open positions, then we buy at the previous day close price, and we have then a long position, and we calculate our performance. So the existing performance of the strategy times the return of the day. Then if we have a no position open, then we still continue with 0 with a closed position, and we took the previous day performance, so we don't calculate the daily performance to this, of course. And if we reach the third trading day of the month, then we close our position. Our signal is -1, and we have no open position. We did 0, and we also don't calculate then, of course, then a new performance. And if we have an open position, then our position is continue be open. We don't have any signal, of course, in this case, and we calculate the daily return to our existing performance. Why we need to check if the position are open or closed? Because we started at month's beginning, and on the third day of the first month, in January 1960, of course, we see a signal, or we would see a signal here. But since we don't have open position, we shouldn't make here a short position. So that's why we need also check if the positions are open or closed. And we go here iteratively to the data frame. So let's check. Yeah, you see here it's the third trading day, third day of the month, and yeah, it doesn't generate any open signals. And for example, you see here in November, that's the last 3 trading days, it gets a signal at the close price of the 24th of November, and then it holds 3-day open till end of November. So we visualize the performance, and yeah, we see here red, green, that's our buy and sell signals. And yeah, here you see our performance. The green line is the buy and hold performance, and the blue line is our strategy. I mean, generally the strategy now looks poorer than a buy and hold, but which in this case could make sense because we just have open positions for 3 days, so it's shouldn't be any issue that it underperforms because we have a lot of liquidity. So we need to do another check. So we will do a t-test. What does the t-test do? It measures if there's a significant difference between 2 means. So we take the mean of the days where we have open positions, and we take we calculate the returns where we have open position. That's the last 3 trading days and the first 3 trading days of a month. And we calculate this. Yeah, we have a mean return with this strategy of 20% annually. This looks quite good. Our t-test statistic is also very high, and our p-value is extremely low. What does this say to us? So we refused that the means are equal, and we can say that we have a significant difference between these periods, and yeah, there is a significant difference between the 6 days around the turn of the month to the rest of the months. We took a time series from 1960, but let's check what happened in the past years. I took here 2015, and I also don't take the index. I take the SPY fund, so it's a mutual fund of the S&P 500, and calculate this again. And let's check our chart. Yeah, it's not that clear. We have also high performance during the months. Let's see what the statistic will say. And we see here, yeah, a high p-value, which would say that the statistic is not absolutely not significant, So there's no difference between the returns at the turn of the month than to the rest of the months. So we see here diminishing returns of the strategy. What can we say here? That the strategy does not work on at least on the S&P 500 Matal fund. There are some markets where the strategy still works, but you still have to search. For example, it works somehow in the emerging markets, and I take here the Vanguard Emerging Market Fund and run the code, and let's see what we have a result. We have data from 2015. Yeah, we see here a significant outperformance at the first day of the month, negative the last 3 days, and mixed out of the turning months period. And let's see what the statistics say. Yeah, the performance doesn't look that bad. We haven't that difference than we had before, so it looks a bit better. And yeah, the p-value is still quite high with 28%. So we can conclude here there is no high significant outperformance, but yeah, it would work better, for example, than with the S&P 500, but the significance level is very, very low. Yeah, what can we conclude? I mean, you have to test the turn of the month effect on different stocks, on different indices or different asset classes, and check if it really works there. Yeah, thank you for listening. If you liked it, then please subscribe, and see you next time.